It's Scott Garlis at Stansberry Research. I'm here at the 2019 Alliance Conference in Las Vegas. I'm with Dan Ferris, editor of Extreme Value. Dan, always a pleasure.
Scott, yes, always.
How are you?
Good to see you. Yeah, I'm good.
You as well. So what do you think of the stock market's valuation right here?
I think it's at a record valuation. I think it's higher than it's ever been by a couple of different measures. One of the measures that correlates best with subsequent 10-year returns is price to sales. And we're over 2 times sales on the S&P 500. So this is, one other time in history, the dot-com bubble is when we hit this. So it's that insane in terms of overall stock market valuation. The other one I like is, the old Graham Buffett one, which is market cap to GDP, right? So right now it's up around, I don't know what the exact number is. I just looked at the chart and it's higher than it's ever been. It's like 160% or something. So, higher than the dot-com. So it's funny because, Buffett, he's moved some of the goalposts, and he's moved that one too. When you ask him about the stock market, he said, well, that was a good thing to watch for a long time, but as long as interest rates are low, stocks are cheap. So he's sort of hedging his bet there, in my opinion, and it's one of the areas where he sort of moved the goalposts. But yeah, super expensive is how I see it.
And then what about the bond market?
If the stock market is super expensive, the bond market is sheer insanity, absolute sheer insanity. Okay, so there's 14, 15 trillion right now of negative yielding sovereign debt in the world. That's insane.
It's crazy.
Okay, but you can sort of understand, well, the central bank in Europe is playing games, and the central bank in Japan is playing games. That's where all the negative yielding stuff is. Okay, so I can almost kind of understand that. But there's $1 trillion of negative yielding corporate debt. And there's also negative yielding European junk debt. So it's just as batty as it can get in the bond market. And people are they're lighting money on fire. Like the bond managers are having the year of their lifetime, the career-making year of their lifetime, buying stuff like 100-year Austrian bonds yielding 1%. That's real. I didn't make that up. So
it's hard for me to believe looking at things every day. Like Italy, the interest rates in Italy are lower than they are in the U.S.
Yeah, they are.
Their debt situation in terms of debt to GDP is far worse.
They're lower all over Europe. Everything from like 50-year issues on down are all negative yielding. You got to go up to 100 years to get a positive yield.
It's crazy.
It is. It's sheer insanity.
It really is. Private equity.
Okay, so private equity is a sell signal. And I found this cool thing, like Blackstone, right? Second biggest private equity firm in the world, second only to Apollo. And in the 1998 run-up, that first run-up in the summer of 1998 in the dot-com bubble, they started selling their company. Okay, so they sold 7% to AIG, still a partnership structure. Then they went public, and that was like, 2 years later, dot-com bubble peaks, and it was just that first peak, so they sold into the frenzy. Then fast forward to 2007, within a couple of months of the top of the housing bubble, they sell 12% in an IPO. They go public, right? Then this year, July 1st, they switched from a partnership structure to a C Corp because, the partnerships like equity funds don't like them. They won't include them. Index funds won't include them. And what's everybody want now? Well, index funds are like one of the insane equity vehicles of our lifetime, and Blackstone wants to sell into that frenzy, so they had to change to a C Corp structure. It's like pristine. These guys, and they're private equity they're dealing with $2.5 trillion with a T in cash that they're putting to work, and these guys are selling. I love it. It's pristine. It's beautiful. You wait for these things.
Yeah, last time I checked, they have some smart people working there too.
Yeah, they sure do.
Yeah,
that's right.
So, what would you recommend investors do now?
Get yourself a spread in Idaho. Buy a lot of underwear because you're going to need it. You're going to be changing it 5 times a day at the bottom of the market. But seriously, I'm kidding. What you want to do is, I really haven't changed my tune much, okay? Hold plenty of cash, keep holding your gold, that's treated you really well for a reason, right? And buy value when and where you find it, kind of one company at a time. You know, don't say, do I want to be in stocks or not? Say, do I want to own this particular business or not? Am I overpaying for this particular business? And I think that kind of a thing will treat you a lot better than just trying to, you know, call tops and bottoms and liquidating your whole portfolio because you think it's the top or anything. I would never do that. I would never recommend it. But I do think it's important to identify risk and then respond to what you're identifying. So we respond to the risk in equities by holding plenty of cash. We respond to the risk in, you know, negative yielding sovereign debt in general and the potential for a huge collapse of some kind by holding gold. And we also respond to the equity market by being real careful about the kind of stocks that we want to own. So we're really focused in the Extreme Value newsletter on not overpaying. If we find something cheap, we want to really take a look at it and say, is it just statistically cheap by the numbers, you know, or is it really truly a good deal? And I think, you know, you do all that, and you're going to come out the other side of this thing looking pretty good.
The one trend that I always noticed on Wall Street is the guys that chase tend to have some of the worst performance out there, and that's exactly what you're talking about not doing.
Yeah, this is the time when, you know, all the chasers right now look really hot.
Yeah.
All the people chasing any kind of positive spread in the bond market are looking really smart, and people chasing, you know, really growthy companies, they're looking smart, but and they can look in the rearview mirror 10 years and say, see, I was right. But you know, you don't drive out of the rearview mirror. You drive out that front windshield. So you better be ready for what's coming, you know, down the road.
I agree.
Yeah.
So. It's good not to chase.
Yep, excellent. Don't chase yield. Don't chase return. Period. Just be prudent.
Yep.
Yep.
It's a pleasure as always.
Yeah.
Thanks for your time.
You bet. My pleasure.
Thanks for watching. Stay tuned for more updates and interviews.